Hey investor friends, I'm Michelle Markey and today I'm going to share what I learned from Danielle Town and Phil Town's Invested Book chapter November on when to sell stocks. And a lot of this chapter talks about not only when to sell stocks, but also what Phil Town has learned from Warren Buffett about things to keep in mind about dividends, as well as company stock buybacks, or also known as stock repurchases. And if you also enjoy learning from the best investors in the world like Warren Buffett or Charlie Munger, I'd love if you could please like and subscribe to my video and YouTube channel, because that's what I'm all about, is to learn from some of the greatest investors and pass on the knowledge so we can all be the best investors we can be. So thanks. The chapter starts off with Danielle feeling eager to actually want to buy stocks for real and invest in some of her favorite companies. And she pitches the idea of Whole Foods to her father before Whole Foods got bought by Amazon. And back then, probably around Thanksgiving 2015, she finally bought Whole Foods at $30.85 a share. And she seemed to have done pretty well with that investment because Amazon went on to buy Whole Foods for $42 a share. So I'm pretty sure Danielle profited from her investment in Whole Foods. So it turned out to be a very good investment pick, and I'm glad her father okayed her decision to buy that investment so that she could experience what it's like to buy her first shares for real and know that she's doing the right thing and trying to fully understand a business before she buys it. And then Danielle asks her father, when do you sell stocks? Like, how do you know when it's the right time or the right conditions that warrant for selling your stocks? And Phil says to his daughter, never sell stocks. You would only sell if the story changes. And he cites how Warren Buffett routinely sells stocks, but he says he never wants to sell stocks. So this is a little bit of conflicting ideas, because on the one hand, you kind of want to get profits after your stock might have run up quite a bit. But on the other hand, someone like Warren Buffett's favorite time period to hold his stocks is forever. So how do we reconcile these sort of seemingly at odds kinds of objectives where you want to reap the benefits of owning stocks, but yet if you let go, then there's no guarantee that you'll get to buy into that stock again at a lower price again. So another way to also think about this is when Phil tells Danielle that Warren Buffett talked about this concept of a 20 hole punch card, where imagine throughout your entire lifetime you could only buy 20 companies. And so if we do our homework, we're going to be really selective and careful about which 20 companies we invest in throughout our 90 years of life, let's say. And with that, we're going to think about companies that have moats, which are their durable competitive advantages, and they're generating plenty of free cash flow, and they have great managements whose missions we believe in and that align with our values. So we're going to think very carefully about which of the 20 companies we might like to invest in. And then also another thing to keep in mind is, unless the story has changed, like their moats have been breached, then we might want to hold on to these companies or just stay vigilant about if someone is breaching their moat. Because on the S&P 500, 100 years ago, companies used to be on there for 67 years, and nowadays they're on there for maybe 15 years. So Phil Town cites a number of reasons why we might want to sell, if and only when the story might change with the company. And then a few examples that meet Warren Buffett's favorite holding period of forever include how he's held Berkshire Hathaway since the 1960s, and Berkshire Hathaway bought See's Candies in 1972, which is almost a 50-year holding period. And then among Berkshire's top 4 holdings, it's owned Coca-Cola for 33 years and American Express for 28 years, which is the same age as some millennials. And then in recent years, Berkshire bought Apple in 2016. So even though that's only a 5-year holding, we already know that it's one of Buffett's favorite positions because it's Berkshire Hathaway's #1 position. So I'm pretty sure Buffett is planning to hold that stock for as long as humanly possible. And even though he likes it a lot, Berkshire Hathaway still reduced its position in Apple by 6% in Q4 2020. And you might wonder, why should Berkshire Hathaway reduce its share count in something that you would think it should want to hold on to as many shares as possible? And sometimes there's considerations for if an institution owns too many shares of a company, like let's say 10% or more of a company, then they might have certain reporting rules. So maybe Buffett wanted to keep something like that in mind. But in general, I think I heard from the May 2021 Berkshire Hathaway annual meeting that Buffett sort of regrets selling some of of the shares in Apple, even though it wasn't a large amount that Berkshire has sold in its Apple shares. But you can see that Buffett probably thinks that it's better to just hold on to the shares forever if possible. And Phil expands on some of the reasons why we might sell a stock, and they include if the debt is rising, or the return on invested capital is going down, or the CEO is not being very honest with the shareholders, and then maybe the mission has changed, or maybe the stock has shot well above its intrinsic value in terms of the price it's currently trading at in the markets. So if a company is not worth nearly what it's trading at in the markets, that might also be a time to potentially lock in some profits, like with the example of how Philtown bought Chipotle back in 2009 for $55 a share, and then by 2014 it was trading around $600 per share. So he decided it was time to lock in profits that got him a 60% compounded annual rate of return, and then the stock went back onto his wish list to buy again into the future if it ever went down to a price that he'd like to buy it at. And then as it turned out, the stock continued to go up and it reached around $749 per share before it started being hit with E. coli situations. So when that started happening to a bunch of Chipotle stores, then that hit the stock price, and over a number of years, like maybe 2 to 3 years, the stock price tumbled until it went down as low as around $300 or $250. And then around that price point is when Philtown said that that was his target buy price again. And I'm sure he took advantage of buying as much Chipotle as he could back when it hit its target price again. So in that way, we could see that the only way that the story of Chipotle changed was because it ran up way above what Philtown believed its intrinsic value was. And then when it was selling at below its intrinsic value, like at least 50% off, then he took advantage of buying back into Chipotle. Then Phil tells Danielle about the merits and drawbacks of dividends, and he says how Warren Buffett enjoys getting dividends from companies, which comes out of companies' free cash flows after they've already used some of the cash to grow the business. So technically, whatever's left over, the management and board of directors can decide to do whatever with the cash, and sometimes they issue dividends, and sometimes they also do stock buybacks. So on the topic of dividends, this can be used to reduce the overall cost basis of the owner's original investment in the company. So in Warren Buffett's case, he has sometimes gotten all of his capital that he originally invested in a company back through the company's issuing dividends. And what this can help with is reducing the overall risk of ownership while also increasing overall returns. And Philtown channels Mark Twain in saying that he would like a return of his capital before he likes to earn a return on his capital. So that's just something to keep in mind of how dividends can be useful. And some people really enjoy seeing the money come into their brokerage account because sometimes they live on that money, and there's something that feels nice. It's almost like getting an allowance from your parents. That's the kind of feeling that people have with getting dividends. But then Phil warns about how that can also lead to some people having this contract of expectations with the company that they're always going to get the dividend yield. Like if Coca-Cola ever stopped giving a dividend yield to people, then some people might riot about that because people have become so dependent on getting dividends from something like Coca-Cola. And we can see that among Berkshire Hathaway's top holdings that Buffett is definitely getting dividends still from Coca-Cola and American Express and even Apple, even though for a long time Steve Jobs didn't want to give dividends, and then when he passed away the dividend was reinstated and actually was kind of high for a while, but then since it's high of maybe $2 or $3 per quarter, it's actually been reduced to now being only like 22 cents or so per quarter. So that's only 88 cents per year. So if you bought a share of Apple valued at around $148 per share in the markets right now, you would get paid that original invested capital of $148 in around 168 years by getting a dividend of 88 cents per year. So that's just some food for thought into the pros and cons of owning some dividends. And not to mention, another con of owning dividends is that there's double taxation. Like companies get taxed when they issue dividends to shareholders, and then shareholders also get taxed, usually at whatever your income bracket is in owning the stock. So even if I got like say $1 of dividends, and let's say I'm taxed 15% of it. So I only get to keep 85 cents of $1 dividend. And then if I wanted to generate returns on that, let's say I wanted to have $1.10, I would need to earn 30% on 85 cents just to get to $1.10. Whereas if a company like Apple held onto that money, surely they should be able to deliver at least 10% of returns and holding onto that dollar to get to that same $1.10. And so just something to keep in mind as to how effectively we can generate continuous returns on cash. So in my opinion, I would rather a company hold on to the cash so they can continue to generate higher returns on it than giving it to me, and now the pressure is on me to try to generate higher returns on it after I've already been taxed on it. Furthermore, reinvesting dividends back into companies when their stocks are on sale in the market, an emphasis when they're on sale, is a good way to continue compounding returns. And this is similar advice to what we've learned from conventional investing wisdom. So Philtown agrees with the mainstream there. But unlike dividends, stock buybacks actually avoid the issue of double taxation. But buybacks are not without their own pros and cons. So buybacks can be good if a company buys back its stock and retires the shares if it's trading at below the company's intrinsic value. So if a company repurchases shares at say 50% off what they believe the full value of the company to be, then that's a really good thing. But if they're buying back shares at prices that are way above what the company is actually worth based on the value of its cash flows, then that might not be such a good idea, because that would be kind of like just burning up cash and kind of just throwing it away, and that's not maybe a good use of buybacks. But some things happen when companies do buybacks, and they include that the company reduces its equity. So that means that there's less shares in circulation, and then that causes the return on equity and return on invested capital to go up. And additionally, the earnings per share also goes up, and some CEOs' compensation is actually tied to increases in earnings per share. So sometimes some company managements could be motivated to do some stock repurchases so that they could sort of benefit in their compensation by maybe slightly artificially increasing earnings per share. So one important thing that maybe we could do is check how much earnings per share is going up relative to the amount of stock buybacks the company is actually doing. And as Danielle points out, it's important to actually see if a company followed through on doing the stock buybacks, because sometimes some companies could just announce doing stock buybacks knowing that it will increase the earnings per share, but they might not actually follow through on doing them, but yet then the stock price actually goes up as a result. So it's important to go through the 10K annual reports and the 10Q quarterly reports to see if a company actually followed through with its buybacks. And with something like Berkshire Hathaway, I know that they did $25 billion of stock buybacks back in 2020, and they were on track to do something similar in 2021. And so I can go back looking at how much shares that they've maybe retired out of circulation. So we can see that maybe some of that Berkshire has bought more of the shares, and maybe some investors have also bought some of those shares. But I can go through some of the quarterly and annual reports to see in their common stock repurchase program info how much they bought in the span of a few months, and we can see the different prices that they paid and how many shares they repurchased. So we could verify if a company has actually bought back its shares, and I'm pretty sure Berkshire Hathaway is being truthful and following through how much shares they're rebuying. But in addition, they don't say an exact amount that they repurchase. They kind of just announce it after the fact when they have to file these quarterly and annual reports. So it's good to just check back on the progress of buybacks. But then for us as shareholders, we can then benefit by the value of each of our shares actually being worth more. And actually, in a letter that Buffett released in 2021, he talks about how Berkshire Hathaway had originally owned only 5.2% of Apple, but through the power of Apple repurchasing its shares, Berkshire's stake of Apple actually went up to as high as 5.4%. So that's a whole 0.2% higher of a position that Berkshire now has in Apple without doing anything, without buying more Apple shares. Their position actually increased just because Apple bought back its shares. I like the way Danielle put this, where in essence, Buybacks are like getting an imaginary gain, and they're good as long as management is doing it for the right reasons and it's a productive use of the cash that the company's generating. And sometimes we might not get to realize the gains that we've gotten from companies repurchasing their shares until after we've already sold our shares. And maybe that's when we realize how much we really got to benefit from companies reducing the number of outstanding shares. But Phil says that we should consider buybacks and dividends as a means to reduce basis, but not as a way to determine what companies to own. And I made this kind of mistake back in the day when I was first starting out investing in my teenage years. I used to look for companies just because they issued dividends, and I would try to figure out how much of a dividend is a good amount to get, and the higher the dividend, the better, I thought. But my cousin warned me that sometimes companies that issue too high of dividends could sometimes be in trouble. So maybe we don't want to invest in companies that are issuing too much of dividends, because maybe they need that cash to be reinvested into the company so that the operations of the company can continue to thrive. So sometimes maybe it's not the best thing to get dividends. And so that's just something that I agree with Phil, is that we shouldn't just look at dividends or buybacks alone as a reason whether we should invest in a company, but we should look at the strength of the company's other factors going through its management and their financial fundamentals to decide if a company is actually performing well as a reason for if we would like to own a company or not. And in addition, Phil mentioned some other things, like you don't have to keep tabs on companies all the time. Like you could devote around 6 hours per year per company, and that's mostly in checking out the 10Ks and 10Qs, as long as the story of the company hasn't changed too much. And he also talks about how with something like Charlie Munger, investing can be simple, but that doesn't mean it's easy. But easy comes with gaining mastery, and mastery comes from practicing investing. So with that, if you enjoyed this video or learned something, please like and subscribe. And I wish you well on your journey to being the best investor you can be and achieving financial freedom. Till next time.